people we often do these very long-term studies, and it kind of can mask how much variation there is year to year in these sort of outcomes. So I wanted to kind of highlight that for people.
Cool.
If you want to get sort of the long-term statistics, you really need to be in it for the long haul. Any particular year can go funny on you. Right. The idea here is that, the first most important thing if you're going to place a trade is to pick your strategy. If you're going to do vertical, if you're going to do strangle, right? But then after that, it's about placing your strikes. And then because we want to sort of have consistency, even if we change underlyings or volatility changes, it's probably best to think of your strikes in terms of their deltas rather than just as like a raw number. And then when we're doing that, like I was saying, further out of the money is always going to be higher pop, right? Just because your break-even point is going to be further away. It is what it is. But as far as like the actual amount of money that you get to take home at the end, that can really change where the optimal, which the best performing deltas are going to be. And so I wanted to just sort of see how, as we look over a relatively large data set, how many times each delta has been the best performing one of the year. Get people into thinking about things this way. So we're going to use 16 years of data, and we're going to, sell strangles with a pretty wide range of deltas. And this is all going to be strangles. So if you're sticking to defined risk trades, this isn't immediately applicable. We'll have to do a separate one for when you're considering iron condors. It's a little bit trickier to get it to fit on a slide just because there's a lot more selections when you're picking 2 strikes per trade. And then so what we're going to do is we're going to consider P&Ls both in terms of sort of your initial credit received or in terms of the BPR. I think that those are sort of the 2 most natural ways to think about your closing profit and loss, about sort of what size the position is either in terms of how much extrinsic started in it or in terms of how much capital you had to put up for it. And then we're just going to see how many times each delta was the best or worst performer for each metric, and then sort of in the long term of overall 16 years, how they all performed.
Okie dokie.
All right.
Let's take a look.
Yeah. So in terms of credit received, you get some pretty extreme effects as you go away because, right, the credits for those 10 delta strangles are very low. Mm-hmm. And you can see that, like, in terms of the conditional value at risk, it really gets quite big, right, in terms of the initial credit received, because the credit received is so low, but when you do take a loser, it can still be a big loser. So even though the 10 deltas performed the best, like had the most P&L per credit, right, if you had just scaled up your position in terms of credit, you would have gotten the most money by playing super far to the money in 14 out of the 16 years. You also would have had the worst individual loser in 9 out of those 16 years. So, right, if you're really scaling up your position that big in a really far to the money position, strangles, you're going to get wiped out in one of those years because you're taking really big losers at least, every other year.
Yeah, the 90% probability of success works until it doesn't, right? I mean, that's kind of the key here is that,
eat like a bird, poop like an elephant.
Yes, and it's just a reflection that you have to consider that you will, at some point, the very, very high pop trade is going to go against you. And when it does go against you, your volatility of risk is going to be very, very high. If you're selling one contract of a 30 delta strangle, and you're doing that one time, that's not the same as doing 10 contracts of the 10 delta, even though it uses the same amount of capital and you collect a similar amount of credit. You got to keep in mind that your volatility of risk is very, very high when you're selling those tail options. Even though you might hit 100 of them in a row, that one might take you out.
So yeah, I think the real thing here is to be clear that if you decide you want to play those like super high pop trades, like you can, they do usually go well, but you can't do a whole bunch of them thinking that because each one is really a high probability that the net result is going to be really reliable. It just doesn't scale up that way. The credits are small, and you just have to accept the fact that it's a small ball kind of trade. There's not that much profit to be made there. If you start trying to take big profits way out there, you're also taking really big risks way out there.
Yeah, the size of the trade shouldn't change with the probability assigned to that position on entry. If you're just because something has a very high probability of profit doesn't mean that you should be leveraging up on those positions versus something that's a lower probability of happening. You want to keep your sizing similar there.
So Jacob, just looking at this slide and not knowing the next slide and the takeaways, What would be your answer here? 'Cause I have mine. I want to know what yours would be.
My feeling here is that this slide sort of implies that I'd like sort of the 20 deltas, maybe 16 deltas off of this slide. Those sort of seem, if you're looking in terms of credit, nicely reliable, right? They get to keep a relatively large portion of their credit a relatively large amount of the time. Their conditional value at risk is pretty high, but that's always going to be the case when you're considering conditional value at risk as a fraction of initial credit received. And they don't get super burned very often.
Mm-hmm.
Yeah, I was in that 20-30 range too, but could you make a case for the straddle?
Yes, I think especially because when you're considering in terms of credit received, right, just those big credits are going to look good, right? You're not keeping that much of it, right? You're only keeping 4.2% of it over those whole 16 years. But right, that's because they were big credits, and you don't lose that much, and they do perform well, and they never really get burnt the worst because they're already scaled in, right? You've taken in a lot of credit, so you're not really exposed in the same way.
Very good. Thank you, Jacob.
Yeah.
Next one.
Yeah. Here's why you wouldn't do the 50. Here's why the straddles look worse. It's when you consider things in terms of buying power.
Yep.
And an important little rule of thumb to remember is that buying power is going to be lowest about 10% out of the money. Wherever deltas those fall at, it depends based on volatility, but about 10% out of the money is where you're going to sort of have the lowest buying power for a strangle. So these very far out of the money ones wind up with a high buying power requirement, and the right at the money ones wind up with a high buying power requirement, because buying power is calculated with a couple of terms. One of them is based on a 20% move in the underlying, and one of them is based on a 10% break of the strike. And so if you're way out of the money, then a 10% break of the strike is really big. And if you're right at the money, then a 20% move in the underlying is a really big break.
Yeah. And the 10% in the money isn't that big for the money straddle. So it's
but it works off of which is the worst of those cases.
Sure.
And just if you're about 10% out of the money, then the two cases sort of balance are about the same. And so that's sort of the low point in buying power. And you can see that here in that, everything's pretty flat about which ones are the best behaving ones, but the worst losers in terms of buying power, right? The ones where you most often lose your full buying power are the close to the money ones.
Yeah. So just sorry to cut you off. So for closer at the money positions, your buying power is very close to what your CVAR is going to be, what your conditional value at risk is. Whereas the 10 delta or the tail options are going to be much more based on a tail event type risk in terms of buying power. And that's why, the buying power for both those positions aren't so extreme, right? So the difference in buying power on these positions is going to be, a couple of $100. It's not a massive difference for those two positions.
Well, and also, so these are all managed at 21 days, and you can see here that doing that means that actually your conditional value risk, right, which is sort of your typical bad loser, right, the 5%, the average amongst the 5% worth losers, wasn't even close to the buying power, right, for none of them. Almost all of them, it was sort of in the 30 to 40% of their buying power was sort of what you're really exposed to if you manage early. Right, if you keep those positions on, a lot of them will go up to their buying power. Those bad losers will get there. But by managing early, you can really kind of cut down on how much risk you're at there. So this is another slide where I think the 30 delta column is, I think, between these two ways of looking at things, I think is sort of the real takeaway, as far as it's never the best, it's never the worst, but it's sort of consistently where you want to be.
Cool.
Good job. Good job.
We can hit takeaways. Yeah. So, the idea here is that this is a nice demonstration that if you want to trade your straddles or trade way far to the money, super high pop trades, you have a lot of variation year to year, right? You'll have some really good years doing this behavior, and you'll have some very bad years doing this behavior. In terms of just how to anticipate your risk, BPR did a really nice job. Everything was very flatly in sort of the 25 to 30% range of how much you're really risking there. Whereas when you were considering credit, the really far to the money options were risking way more relative to their credit than the close to the money options. So it was a much more skewed way to measure risk. And that these moderate deltas, right, sort of your 20 to 30 range, rarely perform the best of the worst, but in the long run, they sort of have the good profits and smaller swings. And so I think the sort of my takeaway from this is that if you've got a really strong assumption, you think you're pretty sure about prices are going to sit flat or going to go way up or going to go way down, or the volatility is due to contract or due to expand, and you want to play that assumption, that the high and low delta trades, will sort of give you access to making that sort of expression. But if you're, trying to be a little bit more epistemologically modest and, just sort of doing a workhorse, you've got your core positions, you want to keep them going, you want to get up your number of occurrences, that really for those, you want to try to stick to sort of these more moderate deltas, at least when trading undefined risk.
Yeah, you have the lesser P&L volatility when you're in that like 20 to 30 range, whereas on both ends of the closer at the money and the tail options, you're going to have much wider swings in your P&L over time.
Yeah, some years you're going to feel like a genius, and some years you're going to go broke.
Yes, exactly.
The 20 and 30s, you're never going to be the biggest bell at the ball, but you're pretty consistently going to do okay.
It's slow and steady. We'll
exactly.
take that. That's a good thing.
So from my own personal experience in the market, when I'm starting to get cute with my delta, I'm usually in the 20 to 30 area. That's kind of my sweet spot. It's always been the sweet spot. Before we did a lot of the research for it, that's just where I gravitated to. When things aren't going right, or when volatility is a little bit lower, and I bring out my my wings a little bit more, that 15, 16-ish delta, I've always, not always gotten hurt, but I've always experienced down the road some sort of problem with that lower delta one, where I've never really experienced a lot of pain and issues with the closer to the at the money strikes. So from now, I still make the mistake, Jacob, where I'll, I think I'm taking less risk by going further out of the money, but it seems that they don't work as well when it really does go your way, because you collected such a small credit to begin with. And when you're closer to the money, you're a lot more aggressive with your rolls, and you're continually getting credits, and they just kind of add up, and they kind of save you from that outlier move. You sell a strangle for $2.80 or a $1.90 or something like that. It's really hard, to do something, monumental to save that position. When you have a strangle that's closer to at the money and you're collecting $6, $7, $8, when you roll down for $2, $3, it doesn't, at least for me, it doesn't seem to affect me, and I do a lot better with it. So if my past experiences can help anybody with what they're looking at, if you're really trying to take less risk, stay mechanical and hang in that 20 and 30 range and resist that urge to go to the smaller delta options.
Quick follow-up question for you, Jacob. So we have somebody in the chat asking about, like, if you added a stop for 2 times the credit received on these positions, what do you think, just anecdotally, what would this look like? I mean, my intuition would say that the far out of the money strangles would have a much lesser realized credit value, because you'd be constantly kind of churning out of these 2x losers, and yes, you'd have a much, it would look even worse on those tail options. The biggest drawdowns would obviously be capped, so you wouldn't have the massive tail risk, but you'd almost it would be a churn of a position.
Yeah, I don't think stop losses on far out of the money options are like a reasonable approach.
Yeah,
I think you wind up throwing out the one thing you're supposed to have there, which is a high pop, because you wind up taking in just a lot of losses because things didn't go your way early.
Exactly. You can't kind of couple those together of having super high pop trades and having stop losses, unless you're doing spreads, which have that baked in stop loss for you. You can't. It's death by paper cuts, because you're not selling enough premium and you're taking too many losses on high probability
risk is very different
trades
than like a stop loss. I feel like stop losses, and just every time we do the study, stop losses hurt you so much in pop and in average P&L, and can cut you out of some of your bad losers, but even then they don't catch you all your bad losers, because the worst losers are on those super extreme moves where stop losses don't execute exactly.
Good stuff.
I rarely recommend them. I never use them myself, but
there you go. You heard it from the man himself.
You can get away with it.
Good job out of you. We're going to take a quick 90-second break and come back. We've got more Tasty Live after this. Even the S&P's just made a new low, down 45 and change right now.
They look
They're
sick.
about 4 handles lower than this. Volatility
19.
back at 1910, 1950, 25 was the high from...
Close all watertight doors. That's what the man would say.
I just nibbled a little bit on a broken wing butterfly, but we're going to take a quick... Give me a little bit of long delay. We're going to take a quick 90-second break and come back. We got more Tasty Live after this. Appreciate your time, Jacob. Nikki, we'll be right back.